Look around you. Stop for 1 second and just look at the world we're living in right now. Markets are holding, people are spending money, jobs are being added. On the surface, everything looks fine, stable, like the kind of environment where you can finally start building something real for yourself and your family. But here's what I've learned after 25 years in this business, from Goldman Sachs to running GLG Partners Global Macro Fund to watching capital flows from my perch analyzing markets full-time since I retired at 36. The surface is a liar. The surface is always the last place to crack. I'm Raoul Pal, and if you're watching this, you found your way here not because you want another hot stock tip or another influencer telling you to buy their course. You're here because something in your gut tells you that the rules of money are changing and you want to understand how the game is actually played by the people who run the table, not just the ones placing bets at it. So let me show you what I see from where I sit. I see the capital flows before they hit the news. I see where the leverage is building up. I see where the assumptions being made by some of the smartest people in finance are built on sand instead of stone. And right now I see fault lines, deep ones, the kind that don't show up on a sunny day but become impossible to ignore when the ground starts to shake. Now, I'm not here to tell you the sky is falling. That's not my style. Panic is a trader's emotion, not an investor's, but complacency that's even more dangerous. Complacency is what gets people destroyed in this business. It's what makes smart investors hold positions they should have sold. It's what makes families overextend on mortgages they can't afford. It's what makes whole industries pretend that this time is different when history tells us it never is. I've seen this movie before. I've seen the opening act, the middle act, and the ending. And right now we're in that part of the cycle where people start believing the good times don't have an expiration date. That's the moment I start paying attention. Subscribe to this channel. What I'm about to show you could save your portfolio and maybe your financial future. Part 1. The everything code and recession dynamics. Before I show you the fault lines, let me connect this to my broader framework. The everything code is my thesis that global liquidity is the master variable driving all asset prices. When central banks expand balance sheets, asset prices rise. When liquidity contracts, prices fall. But here's what most people miss. Recessions don't hit every part of the economy equally. They don't knock down the strong houses first. They find the weak ones, the ones built on leverage instead of equity, the ones built on hope instead of cash flow, the ones where people took risks they didn't fully understand because everyone around them was doing the same thing, and when the weak spots break, they send shock waves through the whole system. If you don't know where they are, you can't protect yourself from the fallout. So let me walk you through the 3 fault lines I'm watching most closely, the places where the next downturn will do its damage first and fastest, and I guarantee you they're not where most people are looking. Part 2. Fault line number 1. The private credit bomb. The first fault line is hiding in the shadows. It's in a part of the financial system that has grown so massive, so quickly, that most regulators can't even track it properly, let alone ordinary investors trying to protect their savings. I'm talking about private credit. Unless you're deep in the weeds of finance, you might not even know what that is, so let me break it down simply. Private credit is lending that happens outside the traditional banking system. It's when big investment funds, not banks, loan money directly to companies. Over the past decade, this market has exploded. It's now trillions of dollars. Trillions with a T. Here's the problem. When I started in this business at Goldman Sachs, lending was simple. A company came to the bank. We looked at their books. We checked their cash flow. We made them sign covenants that protected us if things went wrong. Those covenants were like guardrails. They kept the borrower from taking too much risk because they knew we could step in if they did. That's gone in private credit. We're seeing something called Covenant-lite loans. That means the guardrails have been removed. Companies are borrowing money with almost no strings attached, and they're borrowing at levels that would have been unthinkable 20 years ago. Debt multiples that would have gotten a loan rejected in 5 seconds are now getting funded. Because there's so much money chasing deals, the incentives are broken. The people making these loans aren't protecting depositors like banks do. They're managing funds that charge fees based on how much money they put to work, so they put money to work, lots of it, fast and standard slip. I've seen this movie before. It never ends well. In a strong economy, this works. Companies can service their debt because revenue is growing, because consumers are spending, because the world feels stable. But a recession doesn't announce itself with a warning label. It shows up quietly. A customer stops buying, a supplier demands faster payment, a line of credit gets frozen, and suddenly a company with high debt and weak cash flow can't breathe. That's when defaults start. And here's what most people don't understand about private credit. It's not like the stock market where you can see prices moving in real time. It's opaque, it's illiquid. By the time you find out that a fund is in trouble, the trouble has already spread. It's like watching a fire in a building with no windows. You don't know it's burning until the walls fall down. This connects directly to the 11% hurdle rate. Remember, you need 11% returns just to maintain purchasing power, 8% debasement plus 3% inflation. These private credit funds have been promising investors 10-12 yields. Sounds great, right? Until you realize they've achieved those yields by lowering standards and increasing risk. When the recession hits, those yields become losses, and the investors who thought they were beating the hurdle rate discover they were actually taking on recession-level risk for barely adequate returns. Don't F this up means understanding where the hidden leverage lives. Part 3, fault line number 2, speculative assets priced. For perfection, the second fault line is connected to the first, but it's in the public markets. I'm talking about speculative assets priced for perfection. Take a look at certain parts of the tech sector. Not all tech, I want to be clear. Real companies with real earnings and real cash flow will always have value. But there's a whole class of companies whose valuations assume that growth will never slow, competition will never arrive, interest rates will stay low forever, the macro environment will remain perfect. That's not investing, that's hoping. And hope is not a strategy. When I evaluate risk, I don't ask what happens if everything goes right. I ask what happens if things go wrong. What happens if revenue grows at half the projected rate? What happens if the cost of capital goes up 2%? What happens if a recession cuts demand by 15%? If a company can survive those scenarios, then we can talk. If it can't, then it's not an investment, it's a gamble dressed up in financial language. Right now, there are a lot of gambles dressed up as investments. The psychological trap here is recency bias. It's the tendency to assume that what happened recently will keep happening. Because stocks went up last year, people assume they'll go up this year. Because a company grew fast during the pandemic, people assume it will grow fast forever. Because rates were low for a decade, people assume they'll never stay high. I've made this mistake myself. Early in my career at Goldman, I got comfortable with a position because it had worked for months. I stopped asking the hard questions. I stopped stress testing my assumptions, and when it turned, when the fundamentals shifted and the price started dropping, I didn't act. I froze. I told myself it would come back. I told myself I was being patient when really I was being scared. I lost more money in those few weeks than I'd lost in any single trade before. The worst part wasn't the money. It was knowing I'd done it to myself. I'd ignored every lesson I'd learned. I got comfortable, and comfort made me stupid. The market's only job is to surprise you. The moment you think you have it figured out is the moment it changes the game. Part 4, fault line number 3, domino logic and contagion. The third fault line is the one that connects everything else. It's the spillover, the contagion. The way problems in one part of the market don't stay contained. Let me give you a concrete example. Say a private credit fund runs into trouble. They've made loans to companies that can't pay them back. The fund needs cash, so they start selling whatever they can sell. That might include holdings in public markets. Now you have selling pressure in stocks that have nothing to do with the original problem. That selling triggers volatility. Volatility makes banks nervous. Nervous banks tighten lending standards. Tighter lending means even healthy companies struggle to access capital. And suddenly, a problem that started in a corner of the market nobody was watching becomes a problem for everyone. This is what I call domino logic. The first domino is small, easy to ignore, but when it falls, it hits the next one and the next one. And by the time you notice what's happening, the whole row is down. I've lived through this. In 1998, when long-term capital management collapsed, it was a single hedge fund. Most people had never heard of it, but its failure threatened the entire global financial system because of how interconnected everything had become. A consortium of banks had to step in to unwind it before it took down major institutions. That was a warning. A warning too many people forgot by 2008. Today, the interconnections are even more complex, more opaque, harder to see until it's too late. This is why the everything code matters so much. Liquidity is the connective tissue of the entire system. When it flows freely, everything works. When it freezes, the dominoes start falling. And right now, with $38.5 trillion in US national debt, $1 plus trillion in annual interest payments, and a Fed that's arithmetically trapped between inflation and debt service costs, the liquidity environment is fragile. The fault lines exist. They're real. Ignoring them won't make them go away. The question is what you do about it. Part 5, the DFU framework for recession preparation. Knowing where the danger lies is only half the battle. The other half is building the kind of mindset and portfolio that doesn't just survive the fall but positions you to move forward when others are frozen. Let me give you the DFU framework. Don't F this up for recession preparation. Rule number 1, stress test your balance sheet like your life depends on it, because in a recession it does. When I think about risk management, I don't just ask what happens if things go well. I run scenarios that keep me up at night. What happens if I lost my income tomorrow? What happens if the market drops 40% and stays down for 2 years? What happens if rates stay where they are or go higher? What happens if inflation stays sticky at 5% plus? These aren't academic questions. They're the difference between being a forced seller and a patient owner, and in my experience, the forced sellers are the ones who get destroyed in every cycle. They're the ones who have to liquidate at the worst possible moment because they didn't build a margin of safety when times were good. Ask yourself right now, how many months of expenses do I have in cash? Could I survive 12 minus 18 months without income? Am I positioned to buy when others are forced to sell? If the answer to any of those makes you uncomfortable, start making changes, not panic changes, methodical adjustments. Rule number 2, understand the difference between price and value. This sounds simple. It's not. In bull markets, price and value feel like the same thing because everything's going up. You start believing that the market price is the truth, that the number on the screen is what something's actually worth. But it's not. Price is what you pay. Value is what you get. In a downturn, those two things can diverge wildly. When I look at distress situations, I'm not looking for things that have dropped. I'm looking for things that have dropped but shouldn't have. Companies with strong balance sheets, durable competitive advantages, honest management teams, real cash flow that are being sold. Because the market is panicking and treating everything like it's toxic. That's where opportunity lives. But here's the catch. You can only take advantage of that opportunity if you have dry powder. If you're fully invested, if you're leveraged, if you've stretched to buy everything you own, you don't get to be a buyer when the panic hits. You're just a spectator, or worse, you're a forced seller watching someone else buy what you had to sell. This is the part of the cycle where patience stops being passive and starts being strategic. Rule number 3. Real diversification, not fake diversification. I'm not talking about owning 20 different tech stocks and calling it diversification. That's just concentrated risk with extra steps. Real diversification means owning assets that behave differently under the same conditions. Here's what I mean. When recession fears rise, most stocks fall, bonds may rise, flight to safety, gold typically rises, fear hedge, Bitcoin. This is where it gets interesting. Bitcoin is evolving. In 2022, it traded like a risk asset and fell with everything else. But the structural thesis, mathematical scarcity, institutional adoption, currency debasement, hedge suggest it may behave differently in the next crisis. My allocation framework. Hard assets, Bitcoin, gold, hedge against currency debasement, quality equities, companies with pricing power that survive recessions, cash, not a drag on returns, insurance and option value, selective alternatives, energy infrastructure, essential services. When I was young at Goldman, I hated holding cash. It felt like wasting opportunity. I wanted to be fully invested, squeezing every dollar of return, and I paid for that. I paid in sleepless nights. I paid in forced decisions I regretted. I paid in missed opportunities because I had nothing left to deploy when the real bargains appeared. Now I think differently. Cash isn't a drag, it's the ability to act when others can't. Rule number 4. Understand market psychology. Markets are not rational. They're emotional, driven by fear and greed in roughly equal measure. In a downturn, fear takes over completely. It becomes self-reinforcing. People sell because other people are selling. Prices fall because prices are falling. Rational analysis goes out the window if you don't understand that going in. You'll get swept up in it. You'll panic at the worst moment. You'll sell what you should hold and hold what you should sell. I've seen this happen to brilliant people. People who could analyze a balance sheet better than anyone, but couldn't analyze themselves. The person you're listening to right now, the guy who built macro funds and analyzed global capital flows, has made every mistake you can make in markets. I've been too greedy. I've been too scared. I've held positions too long and sold positions too early. The only difference between me and someone who never made it is that I survived my mistakes long enough to learn from them. And what I learned is this. Resilience isn't about being right, it's about being ready. Part 6. I'm watching right now. Let me tell you exactly what I'm monitoring for early warning signals. Private credit stress, default rate sticking up, funds restricting redemptions, spread widening in leveraged loans, speculative asset cracks, unprofitable tech. Breaking down meme stocks and SPACs collapsing, crypto altcoins getting destroyed, already happening, liquidity indicators, Fed balance sheet trajectory, Treasury general account movements, repo market stress, dollar strength, strong dollar equals liquidity drain, credit markets. High yield spreads widening, investment grade spreads widening, bank lending standards tightening. When these start flashing red together, that's your signal. That's when the dominoes are starting to wobble. And that's when you want to be positioned, not scrambling. Part 7. The opportunity on the other side. Here's what I want you to understand. Yes, I'm showing you where the danger lives, but I'm not doing it to scare you into paralysis. I'm doing it so you can see the opportunity. Because every recession creates opportunity. Every panic creates bargains. Every crisis transfers wealth from the unprepared to the prepared. The people who come out ahead aren't the ones who predicted the crisis perfectly. They're the ones who stayed calm enough to see opportunity through the fear when private credit blows up. There will be assets worth buying. When speculative stocks collapse, there will be quality companies on sale. When the dominoes fall, there will be generational opportunities, but only for those who prepared, only for those who stress-tested their balance sheet. Built cash reserves, understood the difference between price and value, maintained the psychological discipline to act when others froze. This is the exponential age. Technology is transforming everything. The opportunities over the next decade are extraordinary, but to capture them, you have to survive the volatility along the way. Let me leave you with this. I've been doing this for over 2 decades. I've seen crashes and comebacks, panics and recoveries, moments when people swore the system was broken forever and moments when they forgot it had ever been broken at all. Through all of it, one thing remains true. The people who prepare are the people who prevail. Not because they're lucky, not because they're geniuses, because they did the work when no one else was watching, because they built resilience when resilience felt unnecessary, because they respected the downside even when the upside was all anyone could see. The fault lines I showed you today, private credit, speculative valuations, contagion risk, these aren't predictions of doom. They're the map, and having a map doesn't mean you're afraid of the journey, it means you're prepared for it. When the recession comes, and I want to be clear, I'm saying when, not if. It won't destroy everyone equally. It will find the weak spots. It will expose the leverage. It will punish the complacent. Don't be complacent. Stress test your positions. Build your cash buffer. Understand where you're vulnerable, and prepare to be a buyer. When everyone else is a forced seller, that's not pessimism. That's professionalism. That's how you play the game at the highest level. The magic is out there, but you have to survive to capture it. Don't F this up.